So I'm here with John Rosier again from John's Investment Chronicle. We spoke about a year ago and John's come back to update us on what's happened in the intervening period. Good morning, John. Just remind our audience a little bit about you.
Morning, Tamzin. I was a professional fund manager for about 25 years, running UK equity portfolios for big pension funds, for local authorities, companies, etc. For the last 7 years, I've been managing my own money, which I've basically been recording in a diary, my website, johnsinvestmentchronicle.com. And the idea with that is that I show the portfolio and I describe all my trades and why I've done them. And very simply, there's lots of people who will give you tips, but I always think tipsters will remind you of the good ones in a year's time and quietly forget the bad ones. I don't have that luxury. So when I have the odd disaster, which does happen, I have to deal with it and say what I'm going to do. It's been great fun. Over the 7 years, I'm up about 170%. So I put £150,000 in to start with. It's now 380,000. I've kept all the income in there, so nothing's come in or out. And compared to the all share, that's a pretty good return. But difficult times at the moment, though.
So when we met up last year, we were in the middle of a bull market and it all felt brilliant and we all thought we were marvellous. It's not been so easy this year. How have you fared in the intervening period? Yeah,
well, when we met last year, as you say, maybe we were coming to the end of it, but last year was great because the portfolio was up about 32% against 13% for the all share. This year's not been so good. Started off, well, the bottom line is I'm down 10.2% as of last night, and the market, I think, is down. Well, the all-share index total return was down 8.6. And to be honest, I'm not really comparing myself against the all-share. I mean, the idea is to make money. But you can't make money all the time. I mean, I think you've got to look out 1 to 3 years all the time when you're investing, aim to make money. But you're not going to make it all the time. There are going to be times when you lose money. And this year is one of those. And it started badly. I had 2 or 3 profit warnings. Card Factory, then Conviviality, and then XL Media. So those 3, I think, cost me about 5% of my portfolio. Ouch. So the first half was pretty tough. Second half, I was going really well up to the end of November. And then December's not been so good. Market's been pretty awful. And again, another couple of profit warnings.
So we learn the most from our mistakes, or that's what people say.
Yeah.
So what do you think you could have learned from the profit warnings that you had?
Oh dear. I mean, they're all slightly different. I mean, Card Factory is quite an interesting company because it has quite high margins, very good cash flow. But I think the problem with them was there wasn't enough growth, and you know, the market's been putting high ratings on companies that have been displaying growth, and they had a profit one, not a disastrous one, but sales weren't as good as expected, and you know, the market's pretty savage in those circumstances, so it got hit down. I mean, it's got debt, but the cash flow is very good. Anyway, I cut that position.
Why did you cut it?
I cut that because I sort of came to the conclusion that the growth wasn't there, and I could see it for some time just languishing, with the market not giving it maybe the rating it deserves in terms of price to cash flow. And that's been right because it's not really done anything.
And what did you put your money into instead?
Oh God, I can't remember. What did I buy in back in January? I mean, I've been sort of buying some overseas exposure. So I bought a couple of funds actually, or three sort of funds earlier this year. So I started putting money into Scottish Mortgage, dribbling that in.
What does that do?
They are a investment trust managed by Baillie Gifford in Edinburgh. It's got a very good long-term track record. They tend to, I mean, hardly any of their holdings are based in the UK. Most of them are US, China and things. And I guess they're always looking for the growth stocks of tomorrow. So big holdings in things like Amazon, Tesla, they've had a holding in for some time, and then some of the Chinese sort of internet stocks, the sort of Baidu's and things like that.
And how's it fared with the tech wobble?
It's come off from sort of August time. It peaked. It's come off with those stocks coming down, but that actually I think it's done reasonably well. I mean, compared to my average in price, I'm flat. I mean, I was up about 15-20% at one stage. I'm flat there. But yeah, undoubtedly, if the US market falls further next year, I think they will come off with that as well.
And going back to the profit warnings and what you've learned from that, so with Conviviality and XL Media, any insights?
Well, the one thing is with all these things, with hindsight, it's always easy. And there's always a lot of people, especially those who didn't hold the stock, who'll point out it was obvious. But with Conviviality, you know, I invested in that originally because I quite liked the management, the CEO who was driving the business, and she was putting together these businesses, reducing costs. This made sense. The problem is it was a low margin business, but you could see the case for margins improving with them removing costs. Now, where we got hit there was that trading wasn't quite as good as expectations. And then they came out with a couple of shockers. One being that they discovered they had a big tax bill and they didn't have the cash to pay it. So this was another example. We've had one more recently where the cash hasn't been there. Incompetence or what? I don't know.
And what about XL Media?
XL Media, I mean, I think the frustrating thing with XL was in January they did one of those opportunistic placings. And I never really liked those. I think that if management have got a good deal they want to do, they should come to shareholders, present that deal and raise the cash. But I think they argued that they need to be able to move quickly, especially with a cash deal. I'm not sure. I mean, opportunistic deals often ring alarm bells. But also, the trading statement or warning came in June, and when you looked at the reasons for it, I did feel that maybe there should have been some warning of that back in January, actually. So again, difficult one, but easy with hindsight to say maybe you should have got out earlier.
But could you have seen it earlier?
Maybe not. Going back to Conviviality, I mean, the one thing, because actually, although I got out of Conviviality in the end at a profit, because I'd been in quite early in the story, but the one thing was that each sort of trading statement or announcement throughout 2016 and early in 17 had led to upgrades in the earnings, always good for a share price. And then I think sort of November last year, you got trading statement which didn't, and actually led to a slight fall in earnings forecast and things. And maybe that was also a warning that things weren't quite as good as they should have been. But again, easier said with hindsight.
Absolutely. So we've also been in quite a tricky market at the moment.
Yep.
What are your views on that?
Well, it's certainly there's a big loss of confidence. Yes, you can see the US where valuations had got high, although earnings growth has been phenomenal, and the economy is doing pretty well. But you've seen interest rates rise and expectations for them rising further. So that's put people looking at valuations saying, are they deserved? And you've had some sort of fall there, which inevitably the rest of the world then sort of follows. The US tends to lead. And then in the UK, on top of that, we've had all this sort of Brexit and political sort of uncertainty, which hasn't helped. I think it's more the uncertainty than anything. And that's just meant that, you know, in the UK, you've had a bit of a liquidity crunch, especially in AIM. I mean, the AIM market, AIM all shares now off 20% from September the 3rd. So it's been pretty savage and pretty difficult to get out of stocks if you've wanted to. And I think it's brought a lot of stocks back to actually quite attractive valuations, because there were stocks where I tend to like stocks that are under 20 times earnings, you know, 15, 16 times with a decent yield, 3-4%, something like that. And there are a lot of stocks that I just couldn't bring myself to buy because they were on 35, 40 times or whatever, although growing fast. But quite a lot of these have come back to under 20 times now, and I think they're looking attractive.
But do you think there's the appetite in the market because it's risk off?
Well, not at the moment. Yeah, I mean, risk on, risk off. Yeah, I mean, not at the moment, but it's. I mean, it feels like we haven't reached the bottom yet. It feels like that. But I mean, the old adage, no one rings a bell at the bottom. You know, I really remember 2003 very well, the day it bottomed. And then back to March 09 when it bottomed in the UK. Again, no one knew that was the bottom. But things just, you know, people say enough is enough. There's more buyers than sellers suddenly.
But we've got the macro backdrop that quantitative tightening is starting and interest rates are going up, certainly in America.
Yeah.
And they've got this inverse yield curve, which is a sign that there's sort of recession on the way.
Yeah.
It doesn't feel a very positive picture to buy into.
It doesn't, but you know, the bottom of the stock market is never positive. I'm not saying we're at the bottom yet.
Yeah.
But the bottom of the stock market is normally pretty gloomy. It's the top when everything looks pretty good. So we have to get that on board. But I totally say the inverse yield, which everyone has now become an expert on. And although, you know, there's some evidence it's not the best indicator. I think the best thing is if you have a really sharp fall quickly, personally. In markets. Quite often that used to happen with bear markets, although we've had some quite long ones, obviously the 2000, 2003 ground on and on. So yeah, the outlook's not great, but you say interest rates in the US, I mean, inflation expectations have come down, so maybe the outlook next year won't be as bad on that front. There's a lot of debt around. I mean, these are all things we know. They're not new. Quantitative tightening. Well, the one thing they're going to do is make sure they don't, I mean, the risk is they tighten too much. Maybe we're already seeing signs that that's stopping in the US for a start, with, you know, expectations for next year coming down a bit.
And in terms of the market moving quickly, do you think algorithmic trading is making everything quicker?
Possibly it does. Maybe also people with leverage and just needing to get out, and therefore driving prices down.
Do you yourself operate on a leverage basis?
No, no, because that would be stressful.
Yeah.
And I try to keep investing as unstressful as possible.
So how do you cope? You get a company and it's given a profit warning. How do you cope with that?
I guess it depends on your makeup in a way, but I mean, I tend to look at I'm a natural optimist. I tend to try and look further than one day ahead. So in the same way as I try not to get too excited if I have a really good day in the market, I try not to get too upset when I have a bad day, and try and focus on a 1 to 3 year time basis looking forward. But you know, when I woke up this morning and 7 o'clock, I saw an announcement from Superdry oh dear, go on, you read through it, and you know the price is going to be down. But I just think it is part and parcel of investing.
What was the price down by?
30%.
Ouch.
So that's quite a hit. Luckily, it is my smallest holding. So luckily, I mean, you tend to build your weights in your portfolio based on your conviction of the stock, also the risk factors and things like that. And in this case, I suppose it's worked in that it's smaller. Would have been better if it had been zero. But the question is now, what do I do with it now?
And what do you do with it?
I tend to sit my hands in situations like this. It's like Tactica last week. I said, just let the dust settle and then try and focus on the right thing to do. Because the problem is, I could just sell it 30% down. That's out the way and move on. But I think if you look at Superdry's share price since it came to the market, it's been very volatile, over a long time. You could have made a lot of money, lose a lot of money, make a lot of money, lose a lot of money. And, at this stage, we're down at these levels. But I think if you look at the enterprise value of the company compared to the sales, and the cash flow should still be there, the balance sheet's pretty good, that the market inevitably, I think, will overdo it. And I think we're probably at that stage now.
And are you in profit on it?
No, I'm not, no, because I bought that middle of this year. No,
Okay.
This isn't one which I bought 3 years ago, though I don't know.
And your cash position at the moment, are you holding a lot of cash?
No, I don't tend to do that. Again, I'm trying to look further out. I try not to call markets because probably not very good at it. And also just try and keep, again, the emotion of the markets out of what I'm doing. I just try and focus on stocks.
So if you want to buy something now, you have to sell something?
Yeah.
And is there anything that you are looking to buy and what would you sell in order to do that?
Right. Well, I talked earlier on that I thought the UK market was looking good value, or certainly there were some stocks that were coming back to looking very attractive. And so I've got about 35% in overseas markets through investment trusts, things like Bailey Gifford Shin Nippon in Japan, which has actually been probably my best holding over the 7 years. And my feeling is that over the next, 3 months, 6 months, I'll probably reduce some of that down and then invest it into some UK stocks, which are on attractive ratings, good cash flow and good yields. Because one of the really good presentations I thought at Mello event the other week was Lord Lee. It's always good to hear him. And again, his presentation was all about his approach and his focus on dividends. And I think dividends are very important. Of the increase in my portfolio over the last 7 years, that 167% increase, 25% of the increase has come from dividends.
Wow.
So, as I said, it started with £150,000. In the first year, the dividend income was about 2,500 in December 12. This year, it's 11,900. The forecast for next year is 12,500. Now, I just keep that money in there and reinvest it. So if I can build my overall dividend income by investing in some of these UK companies, then I think that'll do well for the portfolio on a 1 to 3 year view.
So in terms of shares to buy, what are you most excited about, either on the watch list or in terms of what you've just bought?
Well, watch list, there's quite a few stocks that have come back. Things like Somero. I think that yields 6.5% on a P of about 10.
And you're not worried about the cyclicality there?
I mean, that's a worry. If if you think US is going to go into recession, that would be. I mean, I think we had Ashtead results the other day. They're great. Again, you're looking forward. But I think with Somero, the cash flow should be pretty good. But that is a worry, and I'll keep an eye on it. But that's on my watch list now. Other stocks, Burford. Now that shouldn't, I think cyclicality shouldn't affect them.
And if credit gets tightened, is that not a problem?
That could be a problem again if credit could, but I'm not sure credit will get tightened much further from here. I think if anything, if things get really bad, they'll loosen it again. So that's another one. IG Design, who I met for the first time the other week, I thought they were good. You could feel, I think, reasonably confident of the growth there. The ratings come back to under 20 times. Very impressed with the management. So again, on my watch list. So there's quite a few stocks coming back. I mean, there's a few where the rating hasn't come back far enough yet. In terms of a stock I've recently bought, I've added Duke royalty to the portfolio.
Interesting.
I quite like the sort of royalty approach because I've held Anglo-Pacific for some time, but they're just working in the sort of resources sector. But with royalty, they're investing across geographies and different industries, which I think should give them some stability.
Can you explain a little bit to our audience exactly what they do? Because I think it's quite a complicated one.
Okay, try and keep it simple. So if you're a private company, maybe long established, and you need some financing to build the business, you could go to the bank. Bank terms may be quite onerous, maybe quite short term as well. Or you could raise equity, which would mean diluting yourself. So neither of those may be attractive to you. But with a royalty agreement, it's a bit like having a 30-year mortgage in some ways, in that the financing would typically be that long.
Gosh.
And the person who provides this financing then has an agreement in terms of obviously getting a repayment of the money they've put up over that time. But on top of that, they also get a share of any growth in revenue that will be built into the agreement. So royalty are looking, I think, for around 13% per annum return from entering these agreements. Now, it's a fairly new company. They've done 5 so far, 2 in the UK, 2 in North America, and one in Holland. The one in Holland is quite interesting because it was a riverboat, a river cruise sort of company. And they had 2 boats. I think this financing allowed them to buy a 3rd boat. And a few months back, royalty announced that, on the anniversary, the 1st anniversary of that royalty agreement, because of the growth in revenue at this company, Tomarco, they had basically got a 6% uplift in the annual return they're getting. Now, obviously, that works both ways. I mean, royalty have got to pick their companies properly, and the ones that are growing rather than ones that are going to decline. But it's quite a neat model. And then royalty, what they could do, Duke royalty, what they could do is just plough that money back into further investments. But they made the decision to pay it as an income flow, as dividends to investors. So they pay quarterly dividends. The forecast for this year is March year end, so March 19 is 6.4% dividend yield.
Wow.
I mean, one of the worries at the moment might be that they only have 5 investments. If one of those went wrong, then that would be quite a hit. But they are building that up. I mean, a year or so ago, they had none. So as they diversify, it should just lead to a good flow of income. So I think that there's a chance of good capital growth, because I think the market will start to understand it more and appreciate this flow of dividends coming through, and therefore it will trade on a lower dividend yield. But also there's good scope for dividend growth as well as they enter into further agreements.
Sounds a perfect combination.
Well, fingers crossed.
And how did it come onto your radar?
I guess I'd sort of seen people talking about it, so I was sort of interested and did a little bit of work on it, research on it, but then they were at Mello event in Chiswick, And of course, you've done a video as well. And so that's it came on that way. And also on Stockopedia, you know, Graham Neary, I read his notes on it. So just getting information from lots of little different areas.
So going forward, when we sit here in a year's time, if you're happy to come back.
I'd love to.
What do you think we'll be discussing then? Hopefully not profit warnings. Where do you think the market will be? What do you think we can look forward to?
Gosh. The one thing I hope is that Brexit uncertainty will be out of the way.
Yeah.
And that whatever happens, the outlook will be clearer from that point of view. So that would be good. I think, as I said, we probably haven't bottomed yet in terms of the market, but I would hope that by the time we meet in a year's time, we'll have seen a bottom in the market and that things will have improved, and that we'll certainly. I hope my performance will be better than down 10%.
Do you have any area where you think the bottom will be?
Not really, but one thing, these things tend to, on a short-term basis, go down a lot further than you think. I mean, back to that dividend story. One of the stocks I did really well out of during 2000s was H. Clarkson, and that was a Lord Lee stock. And that's how I first found out about that stock. And it was on a yield of around 5 or 6% for a lot of the time. But then in September 2002, I think it was, the price dipped down and it went to something like a 9% yield. But that lasted a few days. And then the share price did very well over the next 3 or 4 years. So things can get overdone just because of the lack of liquidity and people selling. And so the market could spike down further, but I don't know any particular level. But I mean, AIM's off 20%. If it was off 30%, would that surprise you? Probably not. But I sort of think it's too late to sell.
John, thank you very much indeed.